Other than that, of course, telecom, technology, these are some of your other laggards also in trade. But Sunil Subramaniam too joins in on the show right now. Sunil, hi, afternoon. Good to have you on the show. I guess the next big trigger is going to be the RBI MPC meet, and all chatter is getting louder that it's going to be a 25 bips cut this time around. What do you think is going to please the markets?
Well, what will please the market is obviously not just 25 but 50. But I'm in the minority here where I think RBI may skip a rate cut. And I think that they will focus on continuing the accommodative stance. They'll focus on transmission. They'll make sure that any bottlenecks for transmission. I think the last two rate cuts have not been fully passed on yet. So I think RBI's focus will be more in terms of ensuring transmission because I think the growth numbers have come in very well. You also have other than the GDP numbers, you have the PMI numbers also showing, indicating a very 62, if I remember the flash PMI overall composite that I saw. So my own sense is that maybe, like I said, I'm in the minority. Maybe RBI may skip a rate cut, but give a very good guidance in terms of continuing the accommodative stance and perhaps doing some more steps to ensure the liquidity remains strong.
Right, Sunil. So does that mean now when you go ahead in the markets, do you think that now the entire trend has become more domestic oriented news flow, because you've seen the markets actually do absolutely nothing over the last last 6 months? The only move or only trigger that has been for the markets have been the commentary coming in from global stalwarts. So what's your take? Now you think in the next 6 months the market will actually focus inwards, look at domestic growth triggers or domestic indicators to actually move upwards, and I'm talking about next 6 months as in for the calendar year.
Okay, so actually speaking, it's the positive domestic triggers have already been at play in terms of the fact that the DIIs, especially the domestic mutual funds, this month have stepped up the buying. Otherwise, the international uncertainty that you mentioned would have led to a far significant correction in the Indian markets. That hasn't happened because domestic mutual funds who had built up their cash balances till April end to something like 2.5 lakh crores have started deploying the extra cash in this month and have protected the market. So the domestic factors coming into play are already there in terms of the DMFs coming through. But your point that over the next 6 months, do you think it's these domestics? I think the good news is already in the price. I think the trigger which will drive the market, on the contrary, is something international related. That is India specific international related. I'm talking about the BTA. I think the big trigger the market is waiting for is a satisfactory conclusion of the bilateral trade agreement between the US, and July 9th is when the 90-day pause gets over. So I think if that comes through, the uncertainty that's prevailing around India from an FII perspective, I feel will go away a lot, and you should see the next leg up of the rally happening with the BTA more. And yes, naturally we can say that the BTA is going to open up domestic sectors for export oriented. The story is domestic, of course, but I think the queue for FIIs, and that's what has got to take the market up, because I think domestic fund managers have now begun deploying their cash balances. So the continuance of the SIP book and everything will continue to give them buying support. But a leg up for the market will come from the return of the FII, which I see as post BTA news flowing out. That's the big trigger.
Right, so that's one of the triggers that everyone's waiting for. In fact, you have from agencies reports coming in that the Trump administration wants nations to give them their best offer on trade negotiations by Wednesday. And like Sunil also mentioned, the fact that you have the 90-day tariff pause that will actually get done on July 8th or rather July 9th for us back home. But Akash, I wanted to understand what's your take coming in when you talk about some of these export-oriented sectors. How are they looking to you, especially IT and pharmaceuticals? They've been one of them who they've bear the brunt of what exactly is happening when you talk about the tariff and the commentary coming around that. How are you looking at that space now? Nagaraj?
Yes, rightly said. IT and metal IT has been showing a smart upmove recently, but I don't think that upmove is IT is sustaining the upmove at the higher levels. But I look, pharma is the promising one. We have seen some good amount of downward correction in pharma. I think pharma is likely to show some further upside momentum in the near term. Among the pharma, Sun Pharma, Dr. Reddy, Divi's Lab are the one where I'm expecting upside bounces from the lower levels.
Okay, in the meantime, the one space which has, really been a darling of the market has been defense. And we spoke with Rajesh Kumar Singh, the Defense Secretary of India, who sees sustained growth in the defense space on the back of domestic manufacturing and imported tech as well. He also talked about the budget allocation for modernization of the sector for next year.
In my view, that the defense sector will see sustained growth on the back of domestic industrialization, complemented by a small quantum of cutting-edge technology that we may have to import from outside. So the next year's budget is, I think, the modernization budget alone, which is the capex, is about 1,80,000 crores. India will be spending between 20 to 25 billion dollars per annum for the next decade, if not more, on its modernization budget. At the institutional level, I would say that we need to work on ease of doing business. We need to ensure that the defense industry really suffers from the license permit Raj, and to some extent it cannot be avoided. You cannot produce lethal weaponry without having even a license. You can't delicense these sectors, but you can make it happen faster. We have to ensure that our procurement processes give them an equal access when it comes to orders. That, as I said, I've already committed that we will be ensuring that nomination-based allocations of orders to the public sector will be a thing of the past. We'll increasingly go for competitive bidding across all platforms.
That was the exclusive conversation that we have with Defense Secretary. But let's stay with the defense space, and with major focus on promoting EVs, BEML has planned to launch various environment-friendly projects. That's the word coming in from the CMD of the company. He also spoke about the order book outlook for the company for the year. Listen in.
We decided to, do away with the fossil fuel in a phased manner, the fossil fuel vehicles that we use for transportation. And towards that initiative, we launched the EV initiative yesterday, the rail and metro sector. And in 25-26 itself, we expect that the rail and metro and defense put together will contribute at least 60% to the top line of the company. The backlog of orders, that we could not do in 24-25, those we will complete by December this year. Plus in 25-26 we expect an order inflow of at least around 14,000 crore.
Right. Sunil, how gung-ho are you about defense? The sector has seen a fair amount of run-up already. The valuations as well, not looking cheap right now. But it seems like it's one of those longer-term stories. Would you advise or advocate putting fresh money to work at these levels?
Well, you could have a 7 to 10 year outlook. And the reason for that is that, as you said, a lot of the good news is in the price. But the good news is definitely there. And I think some of them, if I can highlight. So one is that I think there's a 40,000 crore additional replacement order book from the Indo-Pak war, which has to be executed over the next year and a half. We used drones, missiles, UAVs during the war. So I believe about 40,000 crores additional orders have been placed. That's the immediate 1.5 years future. Apart from which, I think two big things are, one is that our exports. I think that the Atmanirbharta of the defense has shown up very strongly, the way we have defended and the way. So there are a lot of order books which are coming not only from the other Asian countries, but even with Europe now trying to de-America itself from a NATO defense perspective. Each European country is now umping up its defense budget, and India stands a very good chance in terms of supplying these things. So I think the export target for the country for defense last year was about 22,000 crores, and I think over the next 5 years it's going to more than double to 50,000 crores. So it's a huge export oriented business. The other thing is that I think the CAGR of the sector itself is probably going to be at about 20% per annum over the next 5 years. So definitely the growth is there, and the order books are reflecting that kind of a growth. So I think that it's the growth story that you need to bet on. But given the fact that because of the sentimental thing rally post the Indo-Pak war, a lot of this is in the price. So over the next 1.5 years, any bad news around anything could have an impact because of the high valuations. But if you stick around there, the earnings growth should reflect into your EPS growth I'm sorry, the EPS growth should reflect into your value growth in the stock market itself. So I think a 20% CAGR for the defense sector augurs very well as a medium to long term hold. Just that on the short term, stay cautious. And if you want to take additional exposure, I would suggest you stagger it over the period of the next year as a monthly STP or SIP rather than put lump sum in at this stage.
Right, so that's the take coming in on defense space, a long-term view coming in. If I want to invest in this one, at least for the next 7 years, is the outlook looks good for defense. But the short term, stay cautious. And Akshay, are you also of the view, stay cautious on the charts when you talk about defense?
Yes, so defense names have had their fair share of runs. So I'm not expecting any major correction or a fall, but it's technically I would say it will enter into a phase where this more of a time correction phase where the stock prices to stay in a range. So I'm expecting a consolidation or a broader maybe a stoppage in trend before the next level of trend resumes. But definitely if you're looking from short-term trading opportunities, yes, the setup says that it will be more range bound sideways. So better to move to other sectors if you are chasing momentum.
Right, okay. Let's move on to another exclusive then. And an overhang may actually clear out for AU Small Finance Bank, and there could be some clarity soon as the RBI is expected to respond to its application for the universal banking license. Ankur Mishra, my colleague, is here with further details on what he's picking up from his sources.
US sources say that Reserve Bank of India is likely to reply to the application of universal banking license by AU very soon. We understand this application was already given last year, and now regulator may respond to it for becoming universal license as per the criteria which was set by Reserve Bank of India. Minimum net worth of 1000 crore is required. Also, there is a requirement in terms of gross and net NPAs. Now, if you look at AU Small Finance Bank, the gross NPAs are well below 3%, and also the net NPAs fall as per the criteria of Reserve Bank of India. If you take into consideration how the bank is been responding in terms of numbers, but all in all, it will depend on Reserve Bank of India's assent of becoming a universal bank. But for now, we understand that this is likely to happen very soon.
All right, thank you for those exclusive details, Ankur, on back of the universal banking license coming in for AU Small Finance Bank. We're expecting some sort of clarity soon, or to emerge soon on that particular space. Nagaraj, let me come to you and let me get your view on the entire auto pack. How is that one looking to you right now? Anything that's striking and that is actually looking very attractive at this point in time in the auto space?
No, auto sector itself is showing a sideways consolidation. If you look at prominent stocks like Tata Motors, Maruti, and M&M, they are all in a consolidation phase. I'm not expecting that any bigger correction at this point of time. But this sector and the most prominent stocks in the auto sector is likely to continue with consolidation movement with smaller dips in the near term, where I'm expecting upside bounces from the lower levels after some correction.
Right, so that's the take coming in on the auto space. Sunil, what's your take, especially when you talk about the entire consumption theme in which also auto pack features? How are you seeing that space, given the fact that now we are going to come into the H2 of the year, and a lot of hopes are riding on the fact that all these softs that you had on the taxation front, on the interest rate cuts, will now start actually reflecting?
I think I'm fairly bullish on that, and it's not just the good news in terms of the 1 lakh crore giveaway and the fact that RBI will have a supportive monetary policy. Even if there's no rate cut, the policy will be supportive and accommodative. And also the fact that we are seeing a good monsoon. So the monsoon means that rural demand. And so what I'm looking forward to eagerly is a flattening of the K-shaped consumption curve into a more U-shaped one, which means I think that the smaller end vehicles, whether they be motorcycles, scooters, or entry-level cars, they should come and beef it up. And I think that's where my focus is in terms of that. The second part of it is that I think within the auto space, tractors, obviously with a good monsoon, we should expect to see a rise in tractors and power tillers and agriculture-related auto equipment. The third aspect is in the BTA itself. I think auto will be a key part for us, and to some extent auto components exports I think will benefit because it's a labor-oriented sector. Finally, when it comes to the pricing, and if you look at the valuations, right, while some pockets in it do appear to be fairly highly valued, the fact is over the last 6 months, if you take, for me, 6 months is a good part because 6 months from now you're in November, which means you're at the end of the selling pressure which started from September by the FIIs, right? So over the 6 months, Nifty has been fairly flat. But you see, realty, auto, they've all underperformed the Nifty. So I think they haven't run up. Private banks, I think, have picked up most of the slack in that period. So to some extent, there is some cushion there. And finally, to speak, with Ganesh Chaturthi in another 2-3 months and the festive season starting, I think times are going to be good for auto numbers. And you saw last month's numbers, the sales numbers for overall auto industry was fairly good. So I think that there's a good bet to play, given that there are a lot of tailwinds in their support now.
Yeah, okay, that's the take coming in on the entire auto pack, but just minutes left to go before we wind down trade for the day. Actually, let me come to you. Any BTST trades that you would like to recommend to our viewers?
Yeah, so I have a couple of trades. You can look at M&M from the auto space. A very strong technical chart setup from a short-term trading perspective, where you can look forward for targets of 3062 from a short-term trading perspective. Maintain a stop loss of 2997 on this buy trade. The second trade is in Tata Chemicals. Again, a healthy technical setup, long additions in FNO, which is promising possible targets till 970 on the upside. You can maintain a stop loss of 866 on this trade.
Nagaraj, what about your BTST ideas?
Yeah, I have two trades for the short term. First one is both are from a mid cap segment. First one is from a shipping side, G Shipping. Chartically, G Shipping after the bounce, it has consolidated the higher levels. The overall chart pattern is indicating some accumulation pattern below the hurdle of 200-day EMA, which is currently around 980, 990 levels. The overall chart pattern is indicating that we are likely to see a decisive upside breakout of 200-day EMA around 980, 990 level in the stock price. So currently trading around 976, 977, one can look to buy at this point of time. And 1030 to 1040 is going to be the upside target, and one can place a stop loss at 940. And the second one is Signature Global. The stock has been in a consolidation phase previously, and it has in an uptrend over the last couple of months. High tops, high bottoms is there on the chart, and now placed at the edge of breaking above the trend line resistance technically. The currently trading around 1258 levels, one can look to buy at this point of time. And 1320, is going to be the upside target, and one can place a stop loss at 1320. Sorry, 1220.
Right, okay, that's the stop loss 1220 on Signature Global. But Nagaraj, great to have you on the show. Thanks as always for your time. Let me also take it across to Ashesha. There's a JP Morgan note on United Spirits, wherein they've upgraded the stock from the earlier neutral to now overweight. They've also raised the target price. Ashesha is here with the rationale that the note talks about.
Well, yes, United Spirits is in focus on the back of this brokerage report that has come in. As you mentioned, JP Morgan has gone ahead and upgraded the stock to an overweight rating versus their earlier neutral rating. In fact, they've gone ahead and increased their target price to 1760 versus their earlier target price of 1450. So that's a big uptick as far as target price increase is concerned. They say they are increasingly growing confident on higher earnings growth delivery that the company is likely to report over the next few years. In fact, they've raised their FY 26 and 27 EBITDA estimates by 3 and 7% respectively. This will be supported by margin improvement and better growth outlook in the prestige and above segment. Remember, this category reported better than expected volume growth in the quarter gone by as well. So the outlook for prestige and above, or P&A segment as we call it, continues to remain very positive. They've also spoken about state-specific factors that are working in companies' favor. For example, Andhra Pradesh market is now opening up. They've doubled the retail outlet reach in the state of Uttar Pradesh. Better excise policy will drive premium sales resilience in the state of Madhya Pradesh, and privatization on retail will also help the company in the state of Jharkhand. So several state-specific factors that are likely to aid the company going forward. Now, the stock performance has been rather muted. They say Nifty is up 4% on a year-to-date basis, but United Spirits, meanwhile, has declined nearly 7% over the corresponding period. and they say upward EPS revision and higher visibility of growth could support stock price performance going forward. So on the back of this JP Morgan report that has come in where they've upgraded the stock to an overweight rating now from neutral earlier, United Spirits is gaining in trade today.
Thank you so much for that, Shesha, for outlining what JP Morgan had to say about United Spirits. But on the sidelines of the Morgan Stanley India Investment Forum, we caught up with Chetan Iyer to talk about India's growth story, the valuations. They're saying they remain constructive on India, Australia and Japan. And also we spoke about the capex theme in India. He had out his views.
India is relatively insulated to the extent to which its exposure to global goods trade cycle is much lower than everybody else. And at the same time, it has this structural domestic demand story, which is also much stronger than the rest of the region. And this is coming in from the fact that the government policies are very focused on pushing in investment. And if you see the trajectory of Indian government, both center plus states taken together, revenue expenditure versus capital expenditure, both the lines are moving in the right direction. Over the last 5 years, we've seen a consistent decline in revenue expenditure to GDP, and that has been taken as an opportunity by the government to increase its capital expenditure to GDP. Services exports grew by 17% on a year-on-year basis. So we think that India's story has been buffered by the structural strength in domestic demand and resilience in services exports. Right now, it is still the government capex, and we had seen a bump down, sort of a small slowdown period for government capex post general elections last year. But we've seen that in the last 3-4 months, there has been a meaningful pickup in government capex. In fact, in the month of March, we saw that both central and state government capex grew up at a very high pace. And that's now taken, 12-month trailing center plus state combined capital expenditure to close to the peaks that we had seen right before general election. So we've seen this strength in government capex coming back again. As far as private capex is concerned, we were expecting that would have picked up a lot more by this time. But to the extent to which we have seen this trade tensions emerge from early this year, that is going to affect the capex outlook not only in the region but also in India. Despite the fact that India has a lower exposure to global goods cycle, the reality is that it still has meaningful exposure of 12% of GDP being its goods exports to GDP.
Right, okay, that's the take coming in on, what the macros are looking like and whether or not it pencils in for a fair value for India equity market valuation or not, and whether it justifies the run-up that the stock markets have been seeing of late. That said, just looking at some of the other sector performers as well. And Sunil, we were just chatting with one of the analysts from Bank of America and talking about the pharma opportunity. What is your own sense with the big overhang being tariffs? You think one is safer with generics? Is CDMO the play, or do you think GLP-1 is where the big opportunity is? I mean, today only we heard the news about Biocon.
Okay, see, GLP-1 is a very specific one. It's going to be a very expensive drug. So while it may come through, the likes of Ozempic and all of that are very high end, and India is becoming the diabetes capital of the world. The potential is there, but I don't know how far the affordability of it will get it to a mass access within the country. Okay, so I'll wait and watch on the GLP-1 opportunity. Between CDMO and generics, I'm still in favor of the generics. The reason is that from a tariff overhang perspective also, I think that the Indian low-cost generic supply to the American healthcare system will protect it. Now, I know it's early days to talk about the BTA, how that will go, but I think that given the skill set available within India and not available within America, and the fact that they're trying to reduce Chinese dependence on APIs and everything, I think Indian generics will come out a winner of any BTA. So my bet would be rather on the generics. CDMO, we'll wait and see for the whole tariff scene, how it plays out. But at this point in time, you asked me to make a preference. I would prefer generics over CDMO.
All right, so that's the spot that Sunil is liking when you talk about this pharma space is the generics when you compare it to the CDMO side of the fence. What's your take on these platform companies, Sunil? How are they looking to you right now, given the fact that we are through the Q4 earnings season? Some of them have given out good earnings, most of them with bad commentary.
Well, I'm a great believer on the platform companies. The only thing is picking winners is difficult. Right? I think I said this on the show earlier, is to play the platform by diversifying, by pretty much buying everybody that's there. Because it's very hard to predict who will be the winner in this kind of a game. Okay, but the overall potential, the growth of that business, the expansion is phenomenal. So I'm a big believer in the whole platform companies. But I think what I'll do is I'll nibble at all of them rather than try and pick a winner in this whole game. So given that it's a fast growth thing, the least is that the growth on an average should translate into returns in the stock market. Whereas if you don't diversify and try to pick one or two, you might end up picking the wrong horse. So I think that's the thing to be very careful, because there will be a lot of early mortalities and great successes. It's a blend of both. So I would say stay in it, but stay diversified.
Right, stay in the platform company but be diversified, and according to Sunil, basically you can look at all of the companies that are listed in the platform space, given the fact that they have exposure to various other elements of the segments when you talk about the platform companies. But let's take a look at what the markets are doing.